Target the place to be? Is Target where you should be buying right here, right now? Well, we'll find out here on Barry Charles. As we look at the Target company, we're going to look why has it gone down 30%, and we're going to look at all the key metrics from revenue, net profit, earnings per share, PE ratio, shares outstanding, the free cash flow, and so much more. And if you stay right to the end, we will give you intrinsic value for the stock so you can start to do more research before you invest into any stock. Invest at your own risk. This is not financial advice. Let's get to it. Remember to like and subscribe if you like the video. Let's get to it. Yes, Target. Yes, the big Target corporation has gone down 30% this year. And will it continue to go down and down and down? Or can we see the upside in the stock? Well, let's take a look at the key metrics to start off with. First, have been doing recently. Let's have a look at revenue. Yes, in 2022 was 107 billion. Where this year is going to be an interesting case of where that market ends up. So it's going to be a bit of a question mark on where it's expected to be. It could be a drop. It's going to be interesting to see how this one goes. That's why the stock hasn't been performing that well this year. The net profit versus loss. Yes, is it a profit or a loss? Well, it has been a profit for a while here, with a $2.7 billion in 2022. But the question mark is the future. Because before it was 6.9 billion in 2021. So this is why you're seeing the decline. There's talk there might be a little bit of improvement this year, but that's no guarantee. But it's really, the slow growth rate is really not helping until as less people start buying stuff from retail stores, which is a sign of a concern that maybe something worse is happening, but no guarantee. We'll look at earnings per share here at 7.6, very healthy for a company like this, been around a long time. PE ratio of 16, so still got a bit of growth in it. You'd want a bit more. The short interest, there's no short interest virtually in this one, only 2%. So no one's expecting this company to go to zero. Let's have a look at the dividend yield. Yes, the dividend yield's about 3.59% at the moment, with a $4.40 dividend over the year, which at the moment has been a current growth rate of 11.6, which is very good to see, and 54 years of consecutive dividend growth. So it is one of those elite dividend players. So absolutely, in terms of dividend, you have been sweet on this company for a good long time. Will it continue? That'll be the question mark. And this free cash flow, when I look at the free cash flow of 1.63 billion, even though it's improvement for 1.5 billion minus 1.5 billion last year. So that is good, but you want to see that continuing to go up and up and up. If that continues to go up and up and up, then you can celebrate and Target's back on track. But the assets, total assets versus total liabilities, at the moment total assets are 53%, not 53 billion to 40 billion in liabilities. So it's a little bit close to the mark here. You want the assets to go up and drop the liabilities a bit. But the big concern with this company, this is the big concern for anyone out there, is the long-term debt, 16 billion. 16 billion, so that would take them, well, in terms of free cash flow, it would take them 10 years to pay it off. So that's not good, especially with the interest rates so high. So paying down some of that debt would be very, very beneficial. Shares outstanding, 461 million. This has been a bit of an interesting one of late. Before 2021, roughly, it had been doing beautifully for you. It continued to buy back shares, but it has crashed. And I mean, not crashed, but it has been slightly going up. So you're getting slightly diluted the last year or so. So it's, in terms of that, that's not a good sign. But you could argue they are buying the shares at a lower rate, so that's maybe a possibility. That's why it's actually good for you, because they're buying it at a lesser rate, not buying it when the stock's at an all-time high, which is really, really just diluting you. So that's maybe just something that if they are delivering out shares in the lower market, it's not such a bad thing. So yes, what's the stock got to do to get back to growth? Well, clearly the big thing with this company is that the free cash flow needs to get up. They got to get that up. The long-term debt is way too high. It's not for the sector really, but when you've got some bigger companies that can have no debt at all, you would want to get that long-term debt down. Consistency in the net profit would be something you'd want to see going forward, but there seems to be a company, obviously depending on how the year goes, whether they go up and down in the cycles, which is probably why this company is hard to continue to invest in. But obviously a lot of them are in for the dividend. If that dividend yield could get down to 4, if you could get the stock down that low, maybe you could start going, yes, this is a stock for me. But let's have a look and see if the stock is value at the moment. Is it actually value? This is what you all come here for, the intrinsic value of the stock. Yes, has Target got intrinsic value, or is it totally overvalued? Well, let's just have a look at the Graham method. This is one of his methods, Graham calculator. So you got share price that we're going to say is 122, just on metrics, and 7.6 is the earnings per share. And we're looking at a growth of 5% at the current bond yield. You end up with around 146 a share is where the fair value is on the growth. If you think the growth can go up to 10%, then you're looking at 225. Now, if for some ridiculous play they can get their earnings per share to double to 15%, then the stock is worth 445 all day of the week. Is that likely to happen? Probably not, but that's just giving you the extreme example of where if the stock's got some insane earnings potential, that's where the stock could go if earnings per share doubled from here. So where is the value right now, in my opinion, in terms of the intrinsic value of Target? Well, looking at intrinsic value for me, I'm looking more at the lower end of the growth rate, 5%, because I don't think Target is really going to grow much higher than that over the coming years, in my opinion. So 146, you might see a bit of a growth spurt if you're coming out of a recession, but after that it'll be back to low single-digit growth for mine. So 146, you take away some of the dividend, you would say the intrinsic value of this company roughly right now is probably about the share price, $120, in my opinion. So I would be wanting to buy the stock ideally at under $100 all day, just to have a margin of safety. If you don't care about a margin of safety and think, it's going to at least get to 146, then you'll buy today. But I like to try and get 100% bang on my stock at least, if not more. Ideally you want to get more than that, but with some of the bigger companies it's harder for them to grow so big. But if you understand, to have them safe, we can get them at discount like we've had with Meta in the past. If you can get them at the right price, then you are living sweet. So your Target to me is probably a not for me stock at the moment. It's definitely in value range. So again, it's definitely value. It's not extreme value, but it could easily go to 200 at some point as well, over the years as well. But to me, I want to get it. I still want to get it lower, but that doesn't stop you from buying it. It's up to you to do your own research and decide to invest into any stock at your own risk. Well, thank you very much. That's just a little summary of Target's stock analysis and where my intrinsic value for Target is. Leave a comment, share this video with all your friends, and remember to like and subscribe to the channel. Have a great day out there.